What if the one part of your portfolio you thought was safe was quietly turning into a liability? I want to take you back for a second. Early 2022, the market's bouncing like a toddler on sugar, tech is throwing tantrums, and everyone's looking for shelter. For me, and maybe for you too, that shelter was SCHD, the Dividend Aristocrat ETF. Stable, predictable, built like a financial Volvo. Not sexy, but dependable as hell. So I parked a third of my money there. No FOMO, no moonshots, just peace of mind, or so I believed. But here's the uncomfortable truth I've come to face recently. That so-called stability, it's not holding up. And worse, if you're not watching closely, it's setting up younger investors like us for a painful wake-up call. You see, SCHD has quietly slipped behind the S&P 500, not just this year. It's underperformed, it's misfired during key rebalances, and it's made some aggressive bets in sectors that swing a lot harder than most people realize. And yet, millions still treat it like a fireproof vault. But if you zoom in, that vault is creaking. This video isn't about panic. It's about pattern recognition, about understanding the shifting rules of the investing game, and realizing that what worked brilliantly from 2011 to 2021 might not be built for 2025 and beyond. Because here's the punchline. The world has changed. Interest rates are higher. Dividend funds are no longer the kings of calm. So if you're between 25 and 50 and serious about building wealth, not just coasting on outdated assumptions, then this video might be the pivot point that saves you thousands, maybe more. Stick around. We're going to walk through what exactly is going wrong inside SCHD, why it's not just about performance, and how you can pivot without blowing up your future. Let's lift the hood on the dividend, darling. What you find may just change how you invest forever. For most investors, SCHD wasn't just another ETF. It was the answer to sleepless nights. It gave you permission to tune out the noise, a fortress of dividend-paying giants, conservative by design and comforting in chaos. I still remember logging into my account during that 2022 roller coaster. Tech stocks were bleeding red. Meme coins imploded overnight, but SCHD, steady. My balance barely moved, and I thought, this is the core I can build on. And I wasn't alone. SCHD became a favorite among US investors who didn't want to chase trends. We weren't looking for 10x returns. We were building financial peace, a slow-cooked path to freedom. That calm felt earned. But here's the thing about calm seas. They don't tell you when the storm is coming. Fast forward to 2025, and the numbers tell a very different story. The S&P 500, up around 12% year-to-date. SCHD, down over 2.5%. Let that sink in. A fund built to defend against volatility is now lagging badly, even while the broader market rises. This isn't some 2008 crash. This is happening in a soft landing environment. And for a so-called defensive fund, that's a flashing red flag. Let's break it down. If you had invested $50,000 in SCHD last January, expecting modest income and safety, you're now sitting on a paper loss, plus a dividend that's suddenly not so attractive compared to 5% treasury bills. Now here's the trap. It doesn't feel like a catastrophe, and that's the danger. Small dips don't trigger panic, but they do compound. And when a fund underperforms in good times, it should raise one question. What happens in bad times? Because if you're losing ground while the market is calm, well, what happens when the winds actually pick up? Now, this next part isn't getting enough attention, but it should be. Every March, SCHD reshuffles its holdings. Usually it's a non-event, a silent tune-up. But in March 2025, something went very wrong. This rebalance landed right in the middle of tariff news, volatile earnings surprises, and wild intraday swings. And this time, the changes weren't subtle. Defensive stalwarts, the kinds of companies SCHD was built to hold, were kicked out. And in their place, new, untested names pulled in at the worst possible moment. One misstep might be forgivable, but the impact was real. In that quarter alone, SCHD dropped 1.16%. The S&P, just 0.36%. That's a massive delta for a fund designed to smooth out volatility. It's like watching your trusted Volvo suddenly swerve into traffic while everyone else is cruising. And if that sounds dramatic, it should. Because it wasn't just bad luck. It revealed something deeper. SCHD's methodology hasn't changed. But the environment it operates in absolutely has. And now it's reacting like it wasn't built for this era. You might have heard people say SCHD got heavy on energy. What most don't realize is how quickly that happened and why it matters. In one rebalance, the fund's exposure to oil and gas nearly doubled, from 12% to over 21%. At first glance, it looked like a smart pivot. Crude prices were rallying, energy stocks were popping, and Wall Street was applauding the bold move. But here's the truth. Commodities aren't loyal. They swing harder than a toddler on a tire swing. And when oil cooled off, that energy overweight started acting less like a tactical bet and more like an anchor. For a fund that promised consistency, this wasn't just a style shift. It was a personality change. SCHD didn't behave like the safe, boring ETF we signed up for. It became something else, something riskier. And the worst part? Most holders didn't even notice the change until it showed up in their performance. This is how safety turns into exposure. Quietly, gradually, and then suddenly. Now, let's talk about the pressure SCHD is feeling from the outside. Because it's not just about what's inside the fund. Here's something most retail investors haven't noticed. Institutional money has been quietly rotating out of dividend ETFs. Why? One word: yields. Right now, 6-month Treasury bills are paying 5%. Money market funds are dishing out 4.8%, with zero price risk. So ask yourself, if you're managing billions, why juggle equities and volatility for the same return? You wouldn't, and they didn't. So capital started flowing out of funds like SCHD, not because they're bad, but because there's an easier way to earn a similar yield without the drama. That outflow drags down share prices. Retail investors feel the pain, and most of them never know why it's happening. It's not manipulation, it's math. When safer alternatives emerge, capital doesn't ask questions, it moves. Now, zoom out. What we're seeing with SCHD isn't a glitch, it's a shift. A shift in what safe means in a high-rate world, and a psychological trap that catches even smart investors off guard. Because here's the dangerous illusion. We think if something performed well for 10 years, it'll keep doing so. It's the comfort of history. SCHD averaged over 12% annually since inception, grew over 380% in total return. That's amazing. But that's the rearview mirror. The windshield shows rising rates, tighter liquidity, and a Fed that's not rushing to save the market. And here's where emotion kicks in. When a fund we trusted starts slipping, we either ignore it or double down. That's the moment that makes or breaks long-term wealth. Because bulletproof isn't the same as future-proof. The world is changing fast, and even the best strategy needs a tune-up. Understanding that is what separates passive losses from proactive pivot. What should you do now? The 3 roads ahead. So here we are. You've seen the data, you've felt the tension, and now the real question is, what should you do next? There are 3 clear paths forward, and they each come with trade-offs. But only one leads to a portfolio that doesn't just survive volatility, it benefits from it. Road 1. Stay the course with SCHD. This is the do-nothing approach. You trust the long-term process, brace for a bumpier ride, and hold steady. It's not wrong. SCHD still screens for quality, still pays out income, but you have to accept that the smoother ride may be gone, for now, and the dividend may hover around 3.5 to 4%. Road 2. Shift toward income. That means replacing or supplementing SCHD with high-yield covered call ETFs like JEPI, QYLD, or SPYI. These funds crank out consistent income by selling options. Great if you want cash flow today, but the trade-off, they cap upside. In a fast bull market, you'll likely lag. Road 3. Lean into growth. This is the aggressive pivot. You reduce your SCHD exposure and allocate toward growth-centric ETFs like QQQM, VUG, or sector-specific plays like VGT and SMH. Volatility increases, but so does long-term return potential, especially if you've got time on your side. Now, what am I doing? I'm going hybrid. A core of market weight growth exposure for the future, a sleeve of covered call ETFs for income today, and yes, a reduced but intentional position in SCHD as my ballast, because I still believe in its discipline. I just no longer lean on it alone. A portfolio that earns while you sleep. Your portfolio should feel like a well-run business. Some departments take risks and chase big opportunities. Others handle the bills. And a few just keep the lights on, day and night. When built right, your investments earn while you sleep. And more importantly, they let you sleep while they earn. This is where intentional diversification matters. Not just for the sake of spreading out, but for the sake of function. Growth ETFs are your R&D. Covered calls are your cash register. Bonds are high-yield savings. That's your vault. Don't fall into the trap of expecting one fund to do it all. That's not strategy. That's laziness disguised as loyalty. And loyalty in investing doesn't get rewarded. Discipline does. Let me leave you with a picture. Imagine standing on a beach. It's quiet. Kids are building sandcastles. Sun's out, water's calm. But far out, barely visible, a wave is forming. It's not loud. It's not obvious. But if you know where to look, you can see the pull beginning. The people around you don't feel it yet. They're laughing, scrolling their phones. But the sand under your feet, it just shifted. That's SCHD right now. What once moved in calm, predictable rhythms is starting to surge. And if you wait until the water's at your knees, it's too late to grab your chair. So here's your call to action. Tonight, write down 3 things. My goal, my timeline, my safety line. Tape them somewhere you'll see every morning. That's your compass. This isn't just another investing video. This is your warning light, your early signal, your pivot point. Because something is going deeply wrong with SCHD. But if you act now, with clarity, with purpose, and with discipline, you'll come out stronger on the other side. I'm Mike. This is Golden Goals, and your future is still in your hands.